Hey everyone, welcome back to Corporate Decoder, the place where we decode the often complicated language of corporate filings. Today, we're diving into the annual report of Expensify, a company that wants to make managing your expenses as easy as, well, easy money. And trust me, with some of the risks they're laying out, they better hope they have it figured out. So, what's this company all about? Expensify is a cloud-based platform designed to simplify expense management, especially for small and medium-sized businesses or SMBs. They automate tasks like receipt scanning, expense approval, and reimbursement. They've processed over 1 billion expense transactions to date. They think that SMBs want easy money management and Expensify wants to be the answer. They have competition, and it's not just other software, they are also battling against the traditional do-it-yourself with a paper envelope and a headache. Expensify focuses heavily on making the platform user-friendly for employees. They believe happy users are the best form of advertising. This approach allows them to rely on word-of-mouth marketing instead of a costly traditional sales team. How does Expensify plan to keep growing? It's a combination of a few things, they think. First, they want to keep improving the platform for current users. Second, Expensify wants to add new features that go beyond basic expense submissions so that more employees use it. And of course, it's a big priority to promote Expensify's unique culture and values. One of those features that is supposed to help adoption is the Expensify card, which is powered by Visa. They see the card as a natural extension of their expense management platform, where they think they can fix some of the problems with traditional corporate cards. Companies get approved fast, can issue unlimited virtual cards, and are promised continuous reconciliation of card statements. They make money through transaction fees from the Expensify card. Outside of expense management, the platform offers bill payment and invoicing features. The goal is to make the entire pre-accounting process, that is, the data gathering and organization before it gets to the accountants, as easy as possible. What is Expensify.org? It's a nonprofit created by the company and focused on eliminating injustice around the world. They're using their expertise in expense management to make charitable giving and volunteering more transparent and convenient. Data security is a top priority. Expensify is PCI DSS Level 1, SOC 1 Type II, and SOC 2 Type II compliant with external parties performing gray box testing. They take privacy and data security seriously. Now, let's talk about some of the key risk factors that Expensify identifies in their report that could affect their business. One of the first risks they mention is fluctuating quarterly and annual results. Their past performance isn't necessarily indicative of the future due to factors outside their control like market conditions, competition, and even health crises. If they fail to meet expectations, the stock price could take a hit. Growth is not guaranteed, and it requires widespread acceptance of their platform, especially the expense management feature. They need to attract new customers, retain existing ones, and expand usage within organizations. Effectively managing their growth, especially internationally, poses its own challenges. The software industry is always changing. Expensify needs to adapt to new technologies, evolving industry standards, and changing customer needs. If they fail to do so, their platform could become less competitive or even obsolete. Pricing is a balancing act. They need to accurately predict the optimal pricing strategies to attract new customers, retain existing ones, and respond to market changes. Incorrect pricing could hurt sales and profitability. Successfully developing and introducing new features is crucial. If they fail to deliver new features or enhancements that meet customer needs on time and on budget, their revenue could suffer. Competition is intense. Expensify faces competition from traditional software companies, corporate card providers, and niche expense management solutions. If they don't compete effectively, their results of operations and financial condition could be harmed. Economic downturns can negatively impact their customers and materially affect Expensify's business. Declining levels of economic activity could lead to decreased spending and reduced revenue. Payments and other financial services regulations are complex and constantly evolving. Failure to comply with these laws could lead to significant fines and legal liabilities. The success of Expensify heavily depends on their senior management team. Losing key employees or their outsourced finance team could adversely affect their business. A share repurchase program doesn't guarantee an increase in stockholder value. It could also increase stock price volatility and decrease their cash reserves. Expensify relies on key third-party vendors for essential services like the Expensify card and travel booking. Losing these providers could disrupt their business and harm their financial performance. Failing to protect their IT systems and confidential information against security incidents could severely damage their reputation, lead to financial penalties, and create legal liabilities. A strong brand is essential. If they can't maintain and enhance their brand, their ability to attract new customers will be impaired. Global economic and political instability, like the war in Ukraine and the conflict in Israel, can have a negative impact. International sales and operations expose them to risks inherent in international markets. They face numerous regulations related to data privacy and security. Technical difficulties and service outages could harm their operations and reputation. Concentrated voting control and significant authority given to the executive committee limits public stockholders' influence on the company. Their company culture is key to their success, and if they cannot maintain this culture as they grow, it could harm our business. Sales outside the United States expose the company to risks inherent in international sales and operations. Now let's get to the financial data. What happened? For the year, Expensify's revenue decreased to $139.2 million compared to $150.7 million in the previous year. Their cost of revenue also decreased, but their gross margin still took a hit, shrinking from 56% to 54%. Sales and marketing expenses saw a big decrease because they cut back on outsourcing and marketing events. And so net loss improved, going from a $41.5 million loss to a $10 million loss. So what does all of this mean? While Expensify emphasizes product-led growth and customer satisfaction, the decline in revenue in the last year raises a yellow flag. The reliance on existing members to drive adoption can be slow, so how do they see themselves scaling this business? Brand awareness and market leadership are key strengths. Still, external factors like geopolitical tensions and economic uncertainty pose risks to their business. In short, there is no guarantee that they can keep expenses low, and as such, net income may continue to suffer in the short term. So, in conclusion, Expensify is in a decent position given what happened. It's not all too great, but it's also not horrible either. The business is well positioned to grow, but there are clearly some risks that they have identified that could jeopardize that growth. Thanks for watching. If you enjoyed, please subscribe, like, and comment.